So the CPI came out for September this morning, and the monthly over month inflation rate was a little bit higher than what we saw in August. So back in August, we saw a 0.3% increase in the inflation rate, which was the lowest that we have seen month over month since January of 2021. It's the lowest that we have seen for over 6 months. But snapping that downward trend that we were seeing in the monthly inflation rates, September sort of increased back up to 0.4%. And that was slightly higher than what economists were expecting. Economists were expecting a 0.3% monthly change. And that kind of sent markets downward a little bit today. Gold and silver pressed upward as, then now there's the expectation that, yes, inflation is not going away. It's actually staying with us. And now the risks are that with a, longer, higher inflation rate, how should we price assets appropriately? Saying all of that, this number today was lower than what I anticipated. So just to recap on what I was covering on my final demand model, I was covering that, thinking that the month over month increase should be about 0.7%. I even thought that if it missed that 0.7% mark, that the CPI would actually push a little bit higher to 1.2, and that's because for the past 2 months the CPI has been underperforming my model. So I thought that for a month it would overperform and sort of correct itself a little bit as the CPI percentage rate of the producer price index for final demand would start pushing back up. It's now at its bottom, close to the bottom of where we saw the CPI back in 2011, where final demand prices were pushing up, and the CPI was pushing up as well, but it wasn't pushing up at the rate that final demand was. And I was thinking we might see a reverse of that situation, but we'll see what happens when the producer price index for final demand comes out tomorrow. In either case, it was in line with the model this month. It came out at 0.4%, so definitely on the lower end. And of course, final demand prices are going to come out tomorrow. That'll give us a forward look into where I think inflation will be headed for the remainder of the year. The outlook right now is, considering the average and the median of the inflation rate ever since we have come out of the pandemic is probably looking for the CPI inflation rate to top off at about 6% year-over-year inflation at the end of the year. We'll see how markets react to that as we start seeing that price up according to my analysis. Now, looking at the long-term situation, I'm beginning to price in that the Federal Reserve will start tapering asset purchases and then actually start raising interest rates according to their timetable. Of course, that's subject to change because the Fed never operates according to their timetable. They'll most likely delay or push back or even maybe push forward if they get panicked by inflation to taper asset purchases and start forcing those interest rates upward. But looking at that and giving the benefit of the doubt that the Fed will actually start curtailing some of its money printing in the future, we're still looking on average at a 4% average annual rate of inflation year over year. And as I've covered in my previous video, bonds are severely underpriced to that inflation rate, and that money will outflow out of the bond market, which will raise the opportunity cost for stocks, possibly force up precious metals. But in any case, a couple things that have been bothering me is that even though the final demand prices are pushing up, look at the average annual inflation rate for final demand. As of August, it was 8.3%, but for the consumer price inflation, it was 5.2%. We're seeing a divergence between final demand annual inflation and the CPI, and we have never seen that divergence developed to this degree. This is unprecedented. So it's a 3% differential. And even at the bottom of COVID, we didn't see a 3% differential. When the oil mini bubble kind of burst thanks to the fracking boom, we did not see a divergence of 3%. We didn't even see a divergence of 2% annualized between the producer price index for final demand and the consumer price index. So they've more or less tracked very closely together, but something disturbing here is that we're seeing kind of a divergence. So it's my guess that the consumer price inflation numbers are going to be pushed upward and sharply pretty soon. I just don't know when. So it's very possible that in the coming months that my final demand model may fail again, but it may fail to the downside. In other words, it may understate what the inflation rate will be month over month, and we may see higher rates of monthly inflation come along. Now, whether that's priced into the markets yet or whether it will be priced into the markets yet remains to be seen. This is just mere conjecture at this point. But either way, precious metals definitely sort of pressed upward from that right now. I mean, silver right now is beginning to correct back downward. So is gold a little bit there. So we'll see how they handle the situation, and especially with third quarter earnings reports and then the GDP numbers this month. One of the things that was puzzling here that may shed some light as to why we're not seeing, the higher rates of inflation that we're seeing a few months ago is that unlike what we were seeing in June, from April to June, the dollar index was actually depreciating. So the dollar was depreciating against a basket of currencies that it is measured against, which has usually been the euro, the yen, the yuan, and several others. And since it bottomed out in May, it has been appreciating in value against those currencies. This suggests that what's going on in those areas may possibly be capital outflows from those countries flowing into the U.S. because of pessimistic outlooks on those nations' economies, particularly in Japan, where the dollar has appreciated by over 3% against the yen, and Europe, where, again, for over the past month, the dollar has appreciated against the euro. In this case, it's appreciated by over 1%. It actually appreciated by over 2% going into yesterday, but then today it's sort of corrected a little bit downward from that. Now, while the euro stocks have been down slightly 1.5%, that's more or less about the rate that the Dow Jones has been dropping out. So it doesn't really look like there's too much of a correction out of Europe right now, despite the pessimistic news that we've been seeing about Europe facing an energy crisis and stagnation along with the spike in COVID cases. But in Japan, the Nikkei index for the past month has corrected downward by 8%, and that may feed into some of what's been going on with the dollar appreciating again. We may be seeing some capital flowing out of Japan and into the U.S. One of the things that's interesting, though, is that we're not seeing that to the yuan. We're not seeing the dollar appreciate to the yuan right now, which is very interesting considering what's been going on in China. I thought that would be something that would be a no-brainer, that we would see money start flowing out of China and into the U.S. Now, that with all that being said, the Shanghai index has dropped by 3% over the past month compared to the Dow Jones, which only dropped about 1.5%. But nevertheless, the money's not necessarily flowing to the U.S. If it is, it's certainly not flowing into the U.S. dollar, which it would have to flow into the U.S. dollar to buy dollar-denominated assets, such as stocks and bonds. So possible that money is going into precious metals maybe, or something of the sort. But very interesting of what's going on. So overall, kind of a lackluster report. I know that markets kind of responded negatively to that, but really, honestly speaking, 0.4% is not nearly as bad as what I've been thinking. I noticed that some of the trends upward on the CPI report, and I'll go ahead and pull that out. But when we look at the CPI report at the tables for that data, the push-ups were in the volatile components. It was not in what is called the core inflation rate. So food and energy is where we saw most of the increase in the CPI. Food increased by 0.9%, energy increased by 1.3%. That accounted for over half of the 0.4% jump. So the core inflation rate really only increased by 0.2%. And although we saw a little bit of a pop back in shelter prices versus last month, where they only increased by 0.2, they actually increased by 0.4. We're finally beginning to see that rising inflation in that shelter component that I've been mentioning from previous videos weeks and weeks ago. It's been offset by a huge drop in transportation services, which mostly is airline fares. That's the COVID situation. That's what's been going on. It's also been because of the COVID mandates that have been going on. And interestingly, apparel has actually dropped in price. Not really sure why that's happening. Used cars and trucks spiked a few months ago, so there's been a little bit of a drop in price from that. So that's kind of kept this core inflation rate down, yet it's still higher from what it was a month ago. Not as high as what it was as the monthly inflation rate 2 months ago, but that sort of explained why we only got the 0.4% increase. More light will be shed tomorrow on on the producer price index numbers. I'm really curious to see what the inflation rate for the producer price index for all commodities will be. That's the front end of the producer price market. If we start seeing a continued decrease in that inflation rate, that could kind of signal to us that producer prices have been peaking. As far as the inflation rates are concerned, we may see some calming that has been going down, which may feed into the final demand prices, which finally would feed into some calming on the consumer prices. On the other hand, if producer prices continue to push upward or plateau where they are and still push upward at the significant rates that they are, that would tell me that the consumer price inflation will more than likely press up against that producer price index. And so we'll see the annual inflation rate most likely push over 6%, maybe even over 7%, and closer to that final demand number, which is over 8% by the end of this year, if not sometime early next year. So I'll keep on the lookout for that. I'll try to do a little bit more of a teardown tomorrow into where I think it's going and how that's going to affect the various classes of investment markets in the U.S., but just keep on the lookout for that, and I'll give you an update tomorrow. Guys, thank you for watching this video. Make sure you click the like button, hit subscribe to my channel if you haven't already. Drop me a comment, let me know what you think about all of this. Click that notification bell so you're notified when I upload the next video, and I'll talk to you tomorrow evening.